Good morning. It is Friday, November 2nd, 2018, and it seems like the big correction is over with. Or is it? Hard to know, isn't it? What we do know is that there's a buyer's strike from the professionals, but mom and pop are buying stocks on that dip, and they were buying right when we were buying. So either we're smarter than the professionals, or the professionals have something going for them. Here's what I think. I think the professionals want to spin these narratives to get what they want, which is lower prices for the stocks they want to own, and they want to short everything else into oblivion because they had some short positions on. I think that they tell you stories over and over again that don't really matter, and they're just speculating, they're guessing. Oh my God, stock market's going down because of the trade war. Oh my God, stock market's going down because interest rates went up a quarter point. Oh my God, this. Oh my God, that. Oh my God, something else. Are you scared yet? Sell me your stocks cheap. And really, that's a lot of what's been going on. Because as I told you, within a week, and then within a couple days, buybacks are what is driving this market. And I don't know what about this chart doesn't jump out to people. Corporate buybacks are at an all-time high. Corporate buybacks slow down dramatically during earnings. And the market adjusts. We were at peak buyback blackout a couple weeks ago. Last Thursday was the day that the most tech companies reported on the stock market. And on 48 hours later, Tuesday, that means that they can start buying back their stock. So on Wednesday afternoon, Thursday afternoon, Friday morning, and Monday afternoon, I was a buyer and I used up all of my cash. Not all of it, but darn near. I'm at a single-digit cash percentage right now, which is, as you know, very low for me. I usually carry between 10 and 25% cash. And right now I'm at a single digit, depending on the account, anywhere from 2 to about 7 or 8% in cash. Now, I have puts that will expire in November and December and January. Some will get put to me. So I will have more cash later on. Also, I'm going to sell some things going into the new year just to right size the positions and create more cash. And I will gradually build up cash during the first quarter. How fast that happens depends on trade issues and how hawkish the Fed sounds. After today's unemployment numbers, which were astoundingly good, but really just made up for last month, I think the Fed is going to stick with their tightening program. I don't think that they should. I think we're at the neutral rate, and I don't think there's any signs of inflation anywhere near. So why not keep the yield curve from going inverted? The long end of the curve clearly doesn't believe that there's a lot of growth coming. I don't believe there's a lot of growth coming. I think that we are in a topping process, and the Federal Reserve can leave us at the top for a very long time if they just back the heck off. But that's not what they like to do. They like to create a crisis every now and then because, listen, this is very important. The United States does well in crisis, especially when it comes to refinancing our debt. So if there's a crisis in 2 years or 3 years or 4 years or 5 years or 6 years or 7 years, whatever the case may be, interest rates plunge, everybody flees to the dollar, and we can refinance trillions of dollars of debt. We've got about $5 or $6 trillion of debt coming due in the next few years. You tell me, is there a likelihood that there is an event to give people around the world a reason to buy the U.S. debt so that we can refinance again for another decade? You want a conspiracy theory? There you go. The Federal Reserve's job isn't really to control inflation, isn't really to seek full employment. It's to protect the dollar. We've talked about this before as the global reserve currency. That means making sure everybody's using it one way or the other, holding it in some way, and so that we can refinance our debt and live higher on the hog than maybe we should be. So keep an eye on the Fed and whether or not they cause the yield curve to be inverted next year. If the yield curve inverts, we've got problems. Now, President Trump was in fact talking about trade in the last couple of days, and the rumor, the trial balloon, was that they are preparing to try to figure out a way to cut a deal with China. I've said all along that that's the point that they'd have to get to. I think there's pushback coming from that moron advisor that Trump has. I don't even remember his name. If somebody wants to cue me, go ahead and tell me the advisor's name. Was it Miller or not Miller? Was it Miller? Smith? I don't know. Yeah, Navarro, Peter Navarro, and the other jerk. But these guys believe that turning the screws on the global economy will help us. And as I've laid out mathematically before, even if we get an extra 0.5% of the global GDP, if global GDP shrinks by more than 0.5%, it's a wash or negative. And right now, the International Monetary Fund and World Bank are projecting that global GDP growth shrinks by well over a percentage point. So next year. So what's the point? And that is something that I have talked about over and over again, is that the idea that we're somehow getting screwed on trade and has something to do with jobs is wrong. Now, the fact that we already lowered taxes on corporations meant that a lot of them were going to move their supply chains over here anyway. There is some reason to have some push on China. There's no doubt about it. They are mercantilist, they abuse the system, and they steal technology. However, a broad-based trade war that shrinks the global economy isn't good for anybody. There have been, at the disposal of the administration, better ways to deal with the Chinese, but because we don't have allies that are backing us right now, because we've pissed on them as well, we're dealing with the Chinese by ourselves, which means that either A, we have to take this trade war to its conclusion, which could be bloody, literally bloody, or we have to cut a marginal deal. And I have said all along that I expect that they will cut a marginal deal. It will include liquefied natural gas. It'll include that the Chinese basically get the technology they want. They just have to pay for it. And really that some of the global supply chain comes over here. And I think if they cut that deal here in the next month or 2 or 3 or 4, everything works out on trade. That still leaves the Fed. The Fed has got a couple of knuckleheads in there. I just don't see a Chair Powell being the dynamic figure that the Federal Reserve needs. I see him being very similar to Greenspan. He's going to raise rates to the point where he overdoes it, and that's going to cause an issue. Given the underlying structure of the market, which is that there aren't very many marginal buyers, right? What is the marginal buyer? I believe I had it in this article. I sure hope I did. Marginal buyer in the stock market the last few years has been the Chinese and the corporations, right? So when the Chinese stopped buying American assets, well, that's not in this article. That meant that we had to replace This is way back in July. I talked about this. We had to replace that demand for stocks. I was going to do a PowerPoint, but there you go. So what happens when the buybacks go away, right? The Chinese have already stopped buying. There's very little market depth. So we have seen in the last 3 weeks, 4 weeks, excluding this week's rally, so that started on Tuesday, and we're going to talk a little bit about that in a second, because we did very well. You get these quick, steep drops, right? So the market basically dropped 10% in 3 weeks, but it was worse than that. 2/3 of the stock market dropped over 20%. It was only a few gigantic companies that held the stock market up because the S&P 500 is market cap weighted. So if we take a look at the stock market by market cap, here are the companies that really hold the index up. Just these 50, all the $100 billion companies. And you see them, Apple, Amazon, Microsoft, Berkshire Hathaway, right? These big companies hold the index up. Flip it over. Now you have these companies. These companies, by and large, got the crap kicked out of them, right? So it was only the giant companies that held the index up. So when people say, well, the stock market only went down 10%, but I was down 20%, why is that? And you have to try to explain that, and you say, well, because we're more diversified than just investing in the 50 biggest companies. Well, why don't we just invest in the 50 biggest companies? Because over the long run, they don't grow as fast. So while they may not go down as much in a correction, they don't grow as fast, and total return over time isn't always the best. Now, that said, you look at this list, and how many of these companies do we own? We actually own quite a few. So we have built in a damper on beta volatility. We've cut our volatility by owning some of these names. Amazon, though, was volatile this time, but Apple isn't right at the moment, but wasn't last week. Microsoft held up. Berkshire Hathaway held up. You go down the list, quite a few of these companies held up. But where is the biggest opportunity? The biggest opportunity is in the smaller names, right? Who is going to be the next big deal? Well, if we rate by shareholder yield, which is a combination of return of capital in 3 different ways, dividend, buybacks, and debt reduction, you take a look and you say, okay, who's out there? And you say, well, Amgen looks kind of interesting. They've got a really high shareholder yield. Morgan Stanley, the banks, I will tell you, mathematically, the banks, because of the way they handle their balance sheets, their shareholder yield numbers are inflated. But because they're reducing debt off their balance sheets and doing stock buybacks, and this is short-term stuff. These are pops. You take a look. Look, Williams companies, Williams, natural gas. Go on down. Whirlpool. I've casually mentioned Whirlpool recently, right? I think they should buy Sears out of bankruptcy. Fifth Third Bancorp. If you're looking for a regional bank, this is probably the one. I've been to Ohio, and I'll tell you what, Ohio's doing pretty good. Energy, really. And you go down the list, L Brands. All these companies that are somehow reducing their debt and buying back shares. So you take a look at a company like Amgen. Okay. Shareholder yield 14.96%. How did they do it? In the last 12 months, they've bought back $16 billion worth of stock. They pay out a dividend. And let's see, have they reduced their debt? No, they haven't reduced their debt. They've just bought back so many shares that it didn't matter. So they borrowed $500 million but they bought back $16.5 billion. That's pretty good. And by the way, they're paying you 2.65%. See, look at the net change in debt here. Who are the big debt reducing companies out here? I'm gonna get rid of these free cash flow numbers. We don't need them right now. Make this a little easier to look at. Get rid of this price to book. No, I'll keep that. Net change in debt. Who's reduced their debt? Again, I'm showing you the banks are able to show that they've reduced debt. That has to do with balance sheet structure. They're still wildly exposed to various risks. Wells Fargo is the biggest lender to the auto market. A lot of junk bonds there, junk debt there. And JP Morgan has big derivative exposure. We've already seen them lose $1 billion twice on trades. So they still have big risk in the banks. I don't like the big banks. I will tell you this. If I had to own one big bank, it would probably be JP Morgan if I was looking for the biggest bang for the buck. It would probably be US Bank Corp if I just wanted the safest one. And I don't really want a big bank, so I'd probably own Fifth Third if I was going to own a bank, which I'm not really going to own a bank. So, not unless they get beat up during a recession. And after the next recession, and the banks are all beat to hell, that's when you buy them, because then they just triple when the economy grows. Who's reduced their debt? Hey, what company is this? Micron Technology. Does anybody know about this company? What's Micron's deal? Let's see here. They've reduced debt by over $9 billion. And has anybody heard anything about a buyback there? Is there a buyback coming with Micron? $10 billion? Somebody say $10 billion? Interesting. Might have to look at that one. Amazon wiping out debt. Oh, they don't pay a dividend, but they're wiping out debt from that free cash flow of theirs. Intel. Anybody know anything about Intel? Yeah. What do they make? Are they a semiconductor company? Yeah, semiconductors. So, interesting. Some of these companies, right? Microsoft is an interesting company. I tell you what, they're one of the piggy banks on Wall Street. Silicon Valley, not really in Silicon Valley. If you're a dividend growth investor and you want dividends and a company that's growing that can support the dividend and increase their dividends, Intel, Microsoft, pretty good companies to take a look at. Now, you say, well, but their dividends aren't that high. Well, are you about the dividend or the total return? I would suggest, especially if your money is in an IRA rollover, that you should be concerned with total return. So it's not just about the dividend. Well, look, the biggest dividend in the market, some company called CenturyLink. They've bought a couple shares back too. Interesting. They just went through a merger, so their debt's a little higher, but they're saving somewhere in the range of $500 million over the next year, just on the synergies. AT&T, big dividend there too. Interesting. Reduced their debt $5 billion, and they bought back a couple $100 million. Interesting. Anybody know anything about AT&T? Something to do with 5G coming, and they have content, and they have a strategy for the unpluggers, right? Because they not only have internet service that's hardwired, but they have internet service 5G coming. Your basic wireless as well, your 4G. And then they have this little company called DirecTV, which even though not a lot of people are buying DirecTV anymore, they still get all those satellites. Interesting to have satellites. Satellites can be useful, right? And they have something called DirecTV Now, which I subscribe to. So you have DirecTV Now, and you really have covered all your bases because boom, 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 these guys just bought all kinds of content, right? Right, it's a Time Warner deal. AT&T is going to go into a growth phase again, and their capex will come down in a couple of years, and that will lead them to be able to buy back a ton of their stock. So their shareholder yield isn't quite high enough yet. We want to see that around 10%. Same thing with CenturyLink. They have huge capex expenditures to build out 5G. Here's why I like CenturyLink, and everybody knows I like CenturyLink. I've been public with this one. I've been public about AT&T as well. CenturyLink is enterprise, right? They're mainly businesses, serving businesses. They have the second biggest international footprint for wires, for cables. They, give you an example, I had to have Spectrum come out and take care of me because I have my computers hardwired because I can't have my Wi-Fi go down for a minute while I'm doing something like this. So corporations are going to stay hardwired. CenturyLink is the backbone for that. You know, they're right there with AT&T and Verizon. In addition, they can cut deals with all the regional cell phone companies to help them with their 5G as well, because they provide the backbone for that as well. So these telecom companies, I would argue, are going to go back into a growth period. The next few years, you might have to wait for them a little bit because they're in capital expenditure mode, but they're paying out huge dividends, and they're even starting to improve their balance sheets. When does the market recognize that? I'm not positive when they recognize that, but they will. Eventually, they'll recognize that. And the thing when we trade, the reason why I scale in, right, over a period of time is because I don't know when the machines and the hedge funds and other big traders are going to decide to spin a narrative that something is good. And I don't know when they're going to start to spin a narrative that something is bad. So I go based on my valuation and that core 4 technique I use, where the fourth leg is price trend, is I'm really looking for reversals and early phase upward momentum. So when I first buy, I'm looking for a reversal, meaning that something that's been going down and then trended sideways is about to turn up. I'm not really looking for V-shaped reversals. Those are hard. That's a falling knife. But something that's been going sideways for a while that takes one last digger, I'm interested in. Now, you don't have to be that aggressive. The reason I'm that aggressive with at least a part of the money that I invest is because the first move up is usually sharp and violent. So if I can buy close to the bottom, doesn't have to be at the bottom, I can usually get that first rally that happens very quickly. Other people will want to see the rally develop first, and they'll miss out on 5 or 10 or 20 points, and that's okay. That's why we don't only buy at our bottom fishing prices, right? So we have prices that are absolute bottom areas that we're looking for, and are not really absolute bottom, but they're so close to the bottom that's when we start to sniff real hard. That we want to take notice. I know traders who only will buy into an uptrend, and that's fine. That is definitely a way to increase your winning percentage in the short term, but it's not always the way to increase your total return. So, you know, I would talk about it with a baseball analogy. Earl Weaver, 3-run home runs, right? Then you have teams that were like the Cardinals for a while in the 80s, or Montreal Expos for a while, where they relied on singles and stolen bases. And the offense for the Baltimore Orioles was always pretty much better because they had a bunch of guys that got on base, and then every now and then somebody hit a home run. The way I do it is like that. Now, if you'd prefer, you know, there's some strikeouts when it comes to home run hitting. If you'd prefer a higher rate of contact, then wait for the uptrend to develop. So that's really up to you. and it's an important distinction. Um, what I want to show you, though, is how I knew that the stock market was going to turn around on Tuesday. And I wasn't sure if the market would recognize it on Monday or not. If you take a look at the price action on Monday, if you go up and pull up your own chart, you'll see that the stock market was down on Monday. It started up, and then it dropped. And then about the last 15 or 20 minutes of the day, somebody came in, or some computer programs kicked in, or both. There's all kinds of buying at the end of the day. So Monday, at the end of the day, erased like half of the loss. And then on Tuesday, Wednesday, Thursday, we've had up days. Today is an up day, but why is part of the market down? In fact, we might even be a little bit underwater now. Yeah, we're a little bit underwater now. And QQQ is getting hit. Why is QQQ getting hit? This is why. Apple. So Apple is down 6.5% right now. I want to ask you something. Do you think Apple is really 6.5% less valuable today than it was yesterday? Serious question. You could say yes. I would disagree with you. I don't think Apple is actually overvalued at all. You take a look at them. Price to earnings ratio is not outlined, right? Quarterly year-over-year growth, 17%, PE of 18. That means the PEG ratio, the price to earnings of growth, which is really what you should be looking at, price to earnings of growth, is about 1. That's what you want. Now, you like it around half for small caps. You want to have a 30 or 40% growth rate and a PE of 20 or 25. But to have a PEG ratio of 1 on the biggest company in the world, think about that. That's a big freaking deal. Huge profit margins, sitting on hundreds of billions of dollars of cash. I showed some numbers the other day that were the most conservative way of looking at Apple, with about $100 billion in cash net. But the reality is that this company is sitting on an awful lot of cash. I think it was $243 billion. But when you subtract out their debt, it was less. So they deliberately carry debt because they were able to finance at such a cheap rate. So they basically have taken cash flows out into the next 10 to 20 years, and they're buying back shares today. Why? Because the interest rates are getting like zero and almost zero. I mean, they're paying 1% on their money, and they're pulling forward all this revenue so they can buy back shares. What does that do for you as an investor? It means that when the company does finally slow down, that your shares will not get too beat up because they will already have reduced the share count relative to growth. Now, here's something that I would keep in mind. When I was out in New York, I went to the Samsung store, and I went to their, all their interactive exhibits, smart home, things like that. Apple is going to have a pretty big space, a pretty big niche within smart homes. And pretty much every home built starting in the next few years is going to be a smart home. I had the cable guy out here, and we were talking about how the wiring works and everything else. You bring in your main cable, and then, if you're in an office where you have a server and every office is connected into that server, server through Cat5 wiring, what's going to happen in your house is that you'll have the hard wires in your walls, and then just a little plug in each room so that you can plug in whatever device you want, or you make it wireless. I think that certain things will be wireless. I think actually a lot of things will be wireless. But you'll still want to have something hardwired from time to time. I would think that a lot of the smart TVs, which I've been looking at, which are freaking amazing, the unplugged world is coming. So do you want to have your television in your living room on Wi-Fi, or do you want that hardwired? You probably want it hardwired. never lose a signal. So Apple's going to have a big space there because they have whatever percentage of the market it is for cell phones, and everything's controlled on cell phone. So you have to expect that Apple's going to have a huge growth phase. It'll just be tied to the ancillary products in the smart world that the iPhone controls. So keep an eye on them. Why is Apple so important to the whole buyback picture? Pretty easy, right? Biggest company with the biggest buyback. We've already established that the biggest corporations are holding the market up because a lot of these companies did not get beat up. Even though the other 450 companies, over 2/3 of them lost over 20%. So there's definitely some cherry picking that you can do if you flip this market over and go to the smallest companies. So of the small companies, who has a buyback? Interesting. Who's that? Goodyear. I've talked about Goodyear before. Why do I like Goodyear? Because electric vehicles need better tires because of the torque. At some point, Goodyear's going to be a buy. They're already buying back shares. Foot Locker, buying back shares. Is anybody out here buying back shares and reducing debt? Who's this? Hey, look. Harley Davidson. Interesting. Pretty good shareholder yield. Pays a little dividend. I will tell you, being in Milwaukee, I know Harley Davidson pretty well, and I don't always own them. But their management, even though he had a little tiff with President Trump, their management wanted an excuse to do some more things overseas, and they got it. Harley Davidson is positioning themselves pretty well. They may still have some lumps to take, but from a financial standpoint, they're not hurting. Keep going. Who's buying back shares and reducing debt? Tip will be the shareholder yield. Oh, look, 2 companies here. Pretty good shareholder yield. Again, we want over 10, but not a lot of those out there. Pulte Group. And residential construction is getting the shit kicked out of it. And we know that we need a lot more houses in the 2020s. Xerox. I don't even know what they do anymore, but their numbers are good. Who's this? Pentair. Small companies, higher growth rates, returning cash to their investors. TripAdvisor. I would have never guessed that one. So that's why I put these sheets into our sheets, right? So that's why in the last month, I've had all these buyback companies out there. And the ones you should be, the shortcut is to look at shareholder yield. And if shareholder yield is good, that means they're returning cash via dividend, they're returning cash via buyback, and they're probably reducing their debt or some combination thereof. So shareholder yield is something that you really want to take a look at. So really, there's about 50 companies with shareholder yield over 8%. That would imply that the stock should double within at least 7 years, maybe faster. The ones at 10%, about 7 years. 12% would be about 6 years, right? Rule of 72 stuff. 15, 16%, about 5 years. You'd expect a double. Really? Whirlpool. Who's been talking about Whirlpool lately? Why do I like Whirlpool? Why is that? It's going on the list here soon. Whirlpool in the smart everything world, they sell everything. Go take a look at Whirlpool's website and take a look at what they build. The brands they have are amazing. And I think that if they buy the Sears name, they could make that almost completely a e-commerce site with destination stores. I love the destination store with websites. concept for various businesses. I think GameStop should go that direction. But in any case, whether they buy Sears or not, Whirlpool's a pretty good website too, right? It's a good URL. These are companies that you can take a look at. And if you can find the ones with lower market cap and higher growth, and they have great financials, and they're paying, and they're returning cash to shareholders and reducing debt, here's one that we bought that I recommended, Cisco. It's unbelievable. Buying back all kinds of shares, reducing debt, paying a dividend, and they are the linchpin of the telecom build out that's going on right now. So, in any case, let's talk about the broader stock market here for just a second. I'll take a look at the questions. Wow, quite a few. We're going to get to oil. Crookie do short list. Somebody asked me about the short list. Our sheets. Who is that? RJB? No, VSL. The very short list doesn't stand for stocks I'm looking to short. Look at all these. Does it look like in any way, shape, or form that I want to short these stocks? No, it's just a short list. There's 8,000 stocks out there. We've got a couple hundred that we cover. Yeah, no. I used to have and I'll add it back at some point. But I was building a sheet of companies that I would potentially short, but we're not there yet. That list will come back for New Year's. So I'm working on a new one now. Very short list just means it's a short list, like literally a short list. And then this is some of the worksheets that I put in from time to time that I pull off of Y charts. Yeah, level 3 was very good. It was good. So I don't think I would have wanted CenturyLink without the level 3, right? So one of the reasons we've been in CenturyLink and collecting that dividend as it inched up was because level 3 that's the one to put them over the top. All right. So in any case, you pretty much all understand why the market went up. Stop listening to the narratives, all these guys coming on. I told you this was going to happen. I told you why it was going to happen. It then happened. And then I told you when to buy within a day or two of when to buy, right? And then the market started going up immediately. Seriously, immediately. Within a day or two. So, when I send something out like this, what I'm buying now, and that's as close as I get to buying the table or pounding the table. So if you bought QQQ from the 25th, right? I'll go 3 months. I was telling everybody in August and September selling the strength because there'd be a correction in October. We got it. And let's go back only a month. October 25th. Actually, we were in the chat and I told everybody I was buying at the end of this day. I told people to buy in here, right? From Wednesday afternoon to Monday afternoon, we're buyers. And then it immediately started going up. Why? Again, on this day, this Thursday, that was the biggest day for tech reporting. And those are the companies that are buying back the most stock. 2 days later, they can start buying back their own stock. Who gets to start buying back their own stock on Tuesday next week? It's Apple, right? Apple reported yesterday. So on Tuesday they buy back shares. And that doesn't just impact them, right? It's the biggest stock in the stock market. It's the biggest stock in QQQ. It's the biggest stock S&P 500. So all the biggest player in buybacks is coming back to the market with money on Tuesday. Could Monday be a little choppy? Sure. But I would watch the end of the day on Monday. I bet that if the market's down on Monday, that at the end of the day there's buying. Guaranteed. I almost guarantee it. All right. So you're welcome for the 401k stuff. That's kind of a harbinger of things to come. I am building out 401kirk.com eventually. Although 401 Kirk will actually just be a landing page, and the 401k stuff will actually be hosted at Fundamental Trends. So, and that's really just going to be asset allocation. It's going to be cheap. Show you how to map funds. If you have a fund that's unconstrained or you have a brokerage window, then this service is fine for you because you just use the ETFs. All right, so let's talk about oil. Okay. Everybody's forecast for oil is that supply and demand would be about equal this fall, which is exactly what's happening. The EIA, President Trump's administration's EIA, believes the production will exceed consumption in the next year. They're wrong. And there's a bunch of reasons why they're wrong. And in fact, I just think they're lying. We know that there hasn't been enough deep water drilling in the last 3 years to provide long-term support to that type of supply. Second, Saudi Arabia has used over half of their spare capacity in the last 4 or 5 months. They only have about 1 million barrels left that they can go and get to add to the global supply. Almost nobody else in Iran has any spare capacity, and Iran has already taken 800,000. There's already 800,000 barrels of oil missing from the international market from Iran, and that'll trickle up over the next several months. They did announce the waivers yesterday, things that we expected or that I talked about. And those waivers are basically to say, hey, you did the best you could. We'll give you till March to get the zeroed oil from Iran. Why? Again, why are we doing this to Iran? Because the Ayatollah is evil. And the whole world needs for that government to move towards its natural state of democracy. Most of the people there support that, and they have a bastardized form of democracy right now. You know, granted, when you have a god who is overseeing things, which is what they think the Ayatollah is, or at least what the Ayatollah says he is, kind of throws a monkey wrench in the whole democracy idea. But you should not put it past the Persian people to take their country back at some point. And if we can weaken the Ayatollah to help them and to make the military take the side of the people versus the Ayatollah is short on cash, can't pay the military. Military says, hey, screw it. Why would we take that asshole side? So at some point, you know, you see regime change there, and the sanctions are a part of that. It's putting pressure on the military as much as it is on the Ayatollah. We're going to see a shortage in oil starting next summer. And that shortage in oil is not going to be dramatic, but it's going to be enough to drive oil prices up to be over $80 a barrel. And I think the market will anticipate that ahead of time. But the only thing that really kept oil from going over $80 a barrel recently is that we just ran into the fall period, fall and winter. That's natural, that's normal, and because of the trade war. And the trade war is what everybody thinks is going to turn demand flat. I don't know if that's true. I still hold out hope on the China trade deal, but we'll see. I don't see a recession next year, although I do think that you're going to see GDP lower than what the government wants it to be, and we'll see. But in general, there just isn't enough supply coming online in the next couple of years to offset rising demand. So until demand flattens out, supply is going to have a hard time keeping up. And remember, the cheapest oil has already been gotten. Every single day, the difficulty of recovering oil gets more difficult, right? Oil is more difficult to recover every progressive day because there's less of the easy oil there. Now, world oil demand, this is just historic. The IEA makes you pay for a membership, so screw them. If you go through each area for production in the United States, well, they don't let me do it. I really want to sort this out. I'd have to download to a spreadsheet. You see that oil production is not increasing all that much, except Texas. Where are you? Texas, pad 3. Pretty big production boom in Texas. That's about it. Pad 3. Pad 2. Pad 1. Pad 3 is really Texas. Really Texas. Take a look at North Dakota here. It really started to flatten out. So it's really just the Permian that's really ramping up. And these companies, we have to be aware with the oil companies that if they start running into more expensive oil and demand for oil starts to flatten, the price of oil will drop precipitously. So I had that chart a while back where I talked about what I thought the curve for oil would be. Oh, that's not the one. Peak oil. There it is. All right. That doesn't want to do it. So in any case, this is the chart I built for oil demand and supply and the price curve. So I didn't have oil price falling off a demand and price falling off a cliff until around 2030. Something to keep in the back of your head. The acceleration in EVs is pretty impressive. And what Tesla is doing right now and driving the entire market is nothing short of spectacular and amazing. And I know there's a lot of people out there who like to talk bad about Tesla because, oh my God, Elon Musk is sucking from the government tit. Whatever. They didn't get any more subsidies in oil and gas yet. But they got started. And they started a new car company from scratch without all the legacy debt that Ford and GM have. And what you're going to see happen is this curve, this drop up in oil demand, could shift to the left. I don't think the odds of it shifting to the right are very high anymore. I think the odds favor oil demand falling by the late 20s maybe now instead of the early 30s. And that could even get to the middle 2020s. Why? Because the Saudi Arabians are going to tell us to go pound sand, literally, pretty soon. They're going to have their weapons. They're already finding a way to deal with Yemen, which is just quit. And they're going to say, look, United States, thanks. You gave us what we needed when we needed it. We gave you the petrodollar, and now we're going to sell oil to China in yuan, and we're going to pump the shit out of it, and we're going to build out more projects. And the reason they're going to do that in the next couple of years is because countries like Guyana and Algeria and Brazil and quite a few others in Africa, they need oil money. And the only way they get oil money is to drill offshore. So those projects cost a lot of money and take a lot of time. Saudi Arabia can jump them in line. And Saudi Arabia, even though they don't have spare capacity now, they have 2 giant oil fields left that they can hit, one offshore, one onshore. They could probably add 3 to 5 million barrels a day of production. So expect Saudi Arabia to run without spare capacity forever now, so they can make as much money as they can. Don't think of oil in super short term. Right now, your net longs in oil have shrunk. Not a lot of net shorts, but really there's not a lot of net longs either. So that means that we're basically in equilibrium at oil right now. I would speculate that it'll stay this way and chop along for just another month or two. But then going into next year, going into the OPEC meetings, getting to the point where Iran was getting a couple 100,000 more barrels off the market, you're going to see the price of oil drift up higher again. We're at the bottom of the range right now at about 63.41. People were asking me when oil was at 70, 69, 68, hey, should I buy USOU yet? And I said, wait till oil gets into the low 60s. Where are we? Right? And I'm using quantitative analysis for this, and I look at the charts because it's just easy as a shortcut. But I understand what underlies the charts. All these technical analysts who say, well, looks like it's probably going to go up, but it could also go down and it might go sideways. You know what? If you have a fundamental grounding, you can assign probabilities to those things, right? So when you're looking at a chart, you say it could go up, down, or sideways. You know what? What are the odds it's going to go up? What are the odds it's going to go down? What are the odds it's going to go sideways? That's what you need to know. That's what quantitative data tells you. So all these guys who just look at charts and they don't have anything underlying it, they don't understand the numbers underlying the wiggle. If they don't understand the numbers under the wiggle, just ignore them. Ignore them, right? I love Avi Gilbert, but he makes big mistakes once in a while because he doesn't understand the fundamentals under the market. You can assign probabilities. So imagine if you had a technical trader, which I have the capability of doing, and we do as the fourth leg in Core 4, and you can say, okay, I understand, okay, market can go up, down, or sideways. In this particular instance, I can say that it's 80% likely it goes up, 10% likely it goes sideways, 10% likely it goes down. These are the factors that would be the outliers that make it go down. When you see those outliers occur, then you know to change your bet because you were long because you thought it was 80% likely to go up. But if you know that X factor or Y factor will drive it sideways or down, when you see X factor and Y factor occur, you can get out of the trade earlier than all the guys that are watching the wiggle, but they don't know what the signpost is to what the wiggle will do. Make sense? I think it makes sense. So that's why we've been able to hit the hell out of the February and October corrections, right? I mean, how many of you have made double-digit returns on these puts that we bought And how many of you are already even on the QQQ and other stocks that we bought in the last week? You're probably up already. QQQ is 169.73. First time we bought it was 169, and then we bought it in the middle 160s, right? And I think a couple of you got it down right at the bottom. That's a little bit lucky. Good for you. Love it. But when you work hard, luck happens once in a while. That's why we do it the way we do it, because we're not always going to hit the bottoms, but we're going to hit a lot of them just because we know we're shooting in the right direction, right? It's like having a bullseye, and every now and then you're going to hit the middle once in a while. So, all right, I'm not going to talk too much about specific stocks. Apple purchased Nest. Google owns Nest. How would somebody said that Apple purchased Nest? Is that true? How would they have gotten it? Google owns Nest. Yeah, I think you got that one wrong. I'm not buying Apple. Here's why. I own QQQ, and the biggest holding is Apple. So consider that you have Apple exposure if you own QQQ. And do you think that the big growth in Apple, do you think Apple's next growth phase is soon, or do you think it's a few years out? I think it's a few years out. I think the iPhone is flattening, right? It had this big upsurge again. Now it's flattening out. And that has to do with who has money, right? I think Apple has a big growth phase as smart everything world comes online in 2 or 3 years. That's what I think. I can own Apple indirectly through QQQ right now, and I'm cool doing that. All right. Yeah, Google owned Nest like a year ago. Oh, I see. Sorry, I didn't scroll down that fast. Marshall's got his shit together all the time, just about. Except what he doesn't understand that just because India gets a waiver on Iranian oil, hey, by the way, India already reduced their Iranian oil imports by 2/3, and they're just being given 5 more months to get it down to zero. Yeah, Peter, you talk. You make it. It's so hard to read. I know. We're all living in a text world. What is your best guess on energy trade into the end of the year? Who cares? I like Occidental if you like dividends. And remember, we keep this stuff close to the vest. We're not trying to tell the world, right? We're on YouTube mainly for you. This isn't really getting advertised a lot. Occidental has a real nice carbon capture position, and they were smart enough to sell their exporting facility. Why was that smart? The United States is just not going to be a big exporter of oil. We need it. And so when we finally have our final TIF with OPEC, we're going to rely on Canada and Mexico and ourselves. That's the way it's going to go down, and Brazil. We're going to get our oil from this hemisphere in the next 2 years, would be my bet. I bet that we're really not importing anything from Saudi Arabia and the Middle East in 2 or 3 years. How do you like that for a prediction? Now, I predicted back in 2012 that it was going to happen by 2019. I'm going to pull those quotes up in an article soon. We'll see if I'm right. We'll see if the final TIF with Saudi Arabia and OPEC really is in 2019. That was my prediction in 2012. We'll see if it's right. I think Encana can be bought. I think that was a great deal on their part. Antero, I think, is the best natural gas company. We may have to roll our 2020 Leafs at some point. But right now, I'm happy with the 2020 Leafs. We still have time value, and I'm not too worried about that. Has Applied Materials bottomed? I really don't know, but we can take a look. I'm going to give that a firm maybe. Let's look at the longer term chart. So, I mean, it could go down several more dollars probably, but it looks like it's close. It's right at a support level, but I think this is the big support level, about 25, 26. Although this one around 30, meh. Yeah, I'm not super excited about Applied Materials right now, so I don't know why you'd goof around with that one. Now, where are they on our? Where are they on our list? Applied Materials. Next page. Oh, very good shareholder yield. Nice fat buyback. No change in debt. So we have to check to see what their debt is. Price to book value is high. Dividend. I bet it comes down $4, $5, $6 more. I don't know if it'll happen this time or if it'll happen next time, right? It might rally and then next year come back down. I don't like the price to book value, but I do like the growth rate. I think the PE ratio is definitely very fair. Well, that's a really good peg. Debt I'm guessing is reasonable. I haven't done the research on it. Nice margins. Yeah, I'd say we're close on Applied Materials. I don't know what their upside is compared to things like just the QQQ in general, right? So any technology company, measure it against either a technology ETF, XLK, or against QQQ, right? So take a look. Pretty easy way to do this. Add XLK to the chart. You can do this on Yahoo. You can chart out 5 years, normalize it. Yeah. So I don't know why you would own Applied Materials over one of the index ETFs, right? Because their performance has been long term about the same, but you get more volatility with Applied Materials. So unless you can make a compelling case for this to have another period of outperformance compared to the index, I don't think you buy it here. Right now, sometime in the next year or two, maybe you can make that case that you're going to get this type of outperformance for a couple of years. So that would be the case that you need to make. So that's the way I think you should think of it is, okay, at what point is this company going to have a period of outperformance compared to the indexes? Does that make sense? I hope it makes sense. Yeah, I know that people have a lot of 401k money, so I wanted to try to help out with that. Yeah, I agree, RJB. I think that, like I said, the next couple of months, you're selling puts on oil stocks. I don't really know that you go hog wild buying them unless you're under invested, right? If you don't have an allocation there, you go ahead and buy them. And I'd stick with Occidental and Kana and Antero. You could be aggressive with Chesapeake if you want. I like their merger too. So let's talk about the consolidation in the oil space. So Concho last year, Chesapeake now, and Kana, BP bought some companies. The consolidation in any space means that there's going to be more price control by the major players. And that's what's going into oil right now. So not only are we taking some oil off the market, and not only is there a lack of long-term investment, and not only is demand still rising, but the pricing power is being consolidated in the fewer hands. So that's why I think that we still have plenty of room to run in this oil bull market. And eventually, all these buybacks and all this free cash flow that we're seeing from the top oil companies, right? The ones that have good balance sheets, the ones that have good rock, generally the Permian, but Stack Scoop is good, and Eagle Ford is good, and Bakken for now is okay if you're in the center of the play. I've been out to North Dakota several times. You need to be in those middle couple counties. So can't just say I'm Bakken. You have to say where in the Bakken. Um, one thing to keep in mind: next Tuesday there's a vote in Colorado. I've been keeping this on the down low hush hush. I'm going to put an article out on Tuesday. If in Colorado they pass Proposition 112, that's going to be a pretty significant blow to the Colorado oil industry. I don't remember what percentage they are of U.S. oil. It's like 7%, but their growth would essentially end. They have enough oil there that would be accessible with the new rules that they'd still be able to replace the old oil. So it's not like it's going to damage their economy really, but the growth of output from Colorado would pretty much cease. It'd be flat for 3, 4, 5, 6 years, and then probably turn negative at that point. So if you're in Colorado, that's the real scoop on that. It's not going to wipe out the oil market. What it's going to do is kind of put a cap on the oil market for the next 3, 4, 5, 6 years until you have depletion and decline, and then sometime in the middle of next decade, your oil industry shrinks. Now, if you believe in climate change, if you believe that you want to see the oil industry shrink at some point, you should be voting in favor of Proposition 112. If you think that the marginal fractional state, what the state can get from the oil industry growing 5 or 10% per year for a few years is worth it, then you vote no on Proposition 112. But there's going to be literally almost no impact on the state economy of Colorado. And given that you guys have a first mover advantage on the marijuana, this is a great time to say, hey, we want to move away from oil, if that's what you want to do. So that's the deal on Proposition 112. It'll cause oil production to plateau in Colorado, then fall off sometime in the middle 2020s. And Marshall, I'm always nice to you. I only pick on people that I respect. If I don't pick on you when you challenge me, it either means I'm tired, busy, or I just don't. It's not worth my time. And so normally I'm busy, but anyway. So I think somebody asked me privately about oil and just the market in general next year. I posted in a Twitter thread, and you really should follow me on Twitter because some of these conversations get pretty good sometimes. I don't just rip on President Trump. And in fact, I'm going to write at least one nice article about him. He's right about interest rates. If there is a trade agreement with China, then the rally that we just started could last all the way to the end of March. Come April, you have a lot more fiscal year ends, right? So 2/3 of the companies in the S&P 500 fiscal year end is calendar year. The other third are the other 3 quarters, with a big hunk of them being done in March. So the buybacks for those other third of the companies, and here's something I haven't done yet. If somebody wants to do this as an exercise, you take a look, just the top 50 companies. And take a look, and if I have time, I'll do this. But if somebody wants to do this as a homework assignment, take the 50 companies with the biggest buybacks, right? And you can go use the VSL over in our sheets to do this. I'll even rank it by stock buyback if I haven't already. Look at where everybody's fiscal year is. Apple doesn't really matter because they're buying back a boatload of shares. But whose fiscal years go to March, April, May, June sometimes? I mean, they're not always on the quarter, usually. Um, but where is everybody's fiscal year end for just these companies? The ones, well, I guess it'd be nice to go a little further down. And look at all these buybacks over $1 billion. Doesn't that blow your mind? So maybe the top 100 companies, when are their fiscal year ends? I've been looking for a quick chart online somewhere. I can't find it. Nobody cares about fiscal year end, but it actually makes a big difference on the buybacks because it means that these companies get longer to do their buybacks, right? So all the buybacks that were announced last December and January, how long do they really run, right? When there's a big crux of them. Like Micron and some of these companies, the fiscal year doesn't end. They just know they have a ton of money for the next couple of years. But some of these companies, once these buybacks are used up, once the authorization is used up, their next buyback might be very, very small, right? So we're not likely to get. I already erased it. We're not likely to get another huge, right? We're not likely to get this again. Buybacks probably fall down to at least this level and maybe this level by next year. So, we want to kind of keep an eye on when do the buybacks really start to dry up. I think it's by the end of the first quarter. First quarter of the year is also when all the retirement plan money goes in. That's why the first quarter is always a good year for the stock market. So they usually have good comps to get over. They have retirement plan money going into the market, and right now we have all the buybacks. Come April, I'm going to be very concerned that the stock market turns over again. We'll see how the economy is doing. The economy is running really hot right now. I don't know how long it takes for the trade impact to hit, but I suspect it's in the second half of next year. So we're playing with short-term time frames, and that makes it difficult because short-term time frames are very difficult to predict. So one of the reasons we acquired Quality during this last correction is because Quality takes it less on the chin, right? We talked about how some of these big companies held up very well. Well, now we own a lot of these big companies. So that's partially me becoming a little bit more defensive. And again, as the quarter goes on, I will right-size these positions based on whether or not it looks like there's progress being made with China. And I think what's going to happen with President Trump and President Xi in a month or 3 weeks, whatever it is now, is I think they're going to agree to keep working on things and hold off on any more tariffs. Now, how patient is President Trump? Probably not very patient. Come the State of the Union, I think he'll drum up a case, if they haven't cut a deal with China by then, to really lay it on thick. Then you have to worry, right? Trade wars have an unfortunate side effect of leading to real wars. And I don't think we'll ever go to war with China, but we're pushing back pretty hard right now. So we'll see. I suspect that Xi, if he doesn't cut a deal, will just try to wait Trump out. Everybody wants to see what the election is going to look like next week. And, I think by now most of you understand where I'm at. Again, I worked for John McCain, so this will be my 2 minutes on politics before we go. I think the economy is doing well. I think that most of the reason the economy is doing well is the foundation that was laid in the last 8-9 years. I think the Fed had a big piece of that. I think at a certain level, the shovel ready and the other bailouts also had something to do with that. I think the offset, right, the Republican Congress versus Obama, where things were very measured for 6 years, I think that led to stability. I think President Trump being elected led to the breakout of animal spirits, and we got a new wave of stimulus, right? That's what the tax breaks are, and the deregulation is. It's stimulus, something to keep an eye on. Right now, the Office of the Comptroller of Currencies, the Treasury Department, is not enforcing the leverage rules with the banks. They are leveraged up more than 6-1 now. So that's dangerous. The collateralized debt obligations that are out there, and some of the other new exotic vehicles, we have to be very, very mindful of. There is a buildup of debt and of leverage that's going on again. And at some point, that's bad. I don't know how fast it becomes bad, but at some point it's bad. And we have to keep an eye on that. Again, I do think the market is in a topping process. I think the QQQ gets close to 200, maybe hits 200. I think the SPY gets to 300 for sure, maybe 310. Right? Again, look at the companies at the top of the S&P 500. So, I think oil is part of the cause of the next recession. I don't think demand will come down enough, given what supply is, to drive prices any lower than about where they are now. I think we're near the bottom of the range for oil price. And the very best oil companies are going to make money. The Morgan Stanley guy, I think it was today, somebody who's a big deal in energy came on with and talked about Exxon today on CNBC this morning. Yeah, it was CNBC. Joe Kernan wasn't happy with him. And the guy from Morgan Stanley, but look for it on CNBC, basically said that Exxon did okay, but they're so levered to natural gas and they have so many assets that aren't going to pay them, and they have all these legacy expenses that they're clearly not the best way to play oil. Came right out and said it. And Kernan was like, and I've said it before too. Exxon, Chevron, you don't really want to own those. If you're going to be in oil, own the Permian players. Own Pioneer, own Occidental, own Encana, own a Centennial. Centennial, blank check company, good ownership, good assets, the good balance sheet. Centennial could really roll here in the next year. So, do I think oil is in big trouble? No, not yet. Not yet. Supply-demand picture works, and we're not close to a recession yet. But 2020 hasn't come yet. Second half of 2019 is going to tell us a lot. We'll see. All right. What is happening with the frac sand companies? They're crap. You don't want to own them. Figure out an escape route. Yeah. People ask me about the service companies. We sold service companies a while back. We don't own XES anymore because we took a look at the holdings in XES. And I said, I just don't like them. I just don't like a lot of these companies. Yeah, I like Helmerich & Payne. If you want a service company, buy Helmerich & Payne. Right? They've been chopping around. They pay a big fat dividend. And if the service companies do well, this will probably be the one that does it. Right? Look at that debt. Like, they're great. These guys are great. Right? Helmerich & Payne is the one you want if you're going to own one of these. And we bought it way down here, and I sold it anyway. I don't think anybody still owns it. But I can see you owning Helmerich & Payne. I'm not super excited about it, though. I don't think that's where I'm going to make 20, 30, 40% in the next couple of years. Maybe, but it's higher risk, right? Margin of safety investing. Don't reach out for risk. You make money by controlling your risk, not by expanding it. All right, I think that's a good way to end. You guys have a great weekend. I'm going to lunch with my mommy, who's in from Las Vegas. Used to live near here in Wisconsin, but she decided to retire where it was warm, and man, did she get that in spades. All right, I'll talk to you later. Have a good weekend. Expect a lot of content the last 2 months of the year.